Ladies and gentlemen, equity markets here in India, after hitting a new all-time high in September of 2024, have now entered a very volatile phase. And even after 1.5 months, there are no signs that this volatile phase is about to come to an end anytime soon. In the meantime, of course, we have witnessed the historic victory of Donald Trump in the recently concluded US presidential election, something that has led to very strong rallies in equity markets in the United States. But even Donald Trump's victory has not been able to bring any cheers to equity markets here in India so far. Why are equity markets here in India having such a rough patch right now after delivering stellar returns over the last couple of years? More importantly, are there any market strategies or key market variables that can potentially help us navigate equity markets during the course of this volatile phase and even potentially help us accurately estimate how long this volatile phase is likely to persist for? Well, that's exactly what we are going to discuss in this episode. Ladies and gentlemen, welcome to part 2 of this series, where we are trying to understand what are the key drivers of this ongoing bout of volatility that we have been witnessing in Nifty since the beginning of October 2024. And what are the implications for Nifty in the light of the historic victory of Donald Trump in the recently concluded US presidential election? But before that, I want to take this opportunity to wish each and every one of you a very happy Diwali. And I sincerely hope that all of you had a great time celebrating Diwali with your loved ones. Now coming to what I want to discuss in this video. Ladies and gentlemen, what a last couple of weeks we have had. We first had the Fed kickstart its rate cut cycle with a big bang 50 basis point cut on 18th of September 2024. And this was cheered very loudly by equity markets around the world. And in India, the Nifty scaled a new all-time high of almost 26,200 points towards the end of September 2024. But this rally quickly started to unravel from the first week of October onwards. And since then, the Nifty has corrected by almost 8% from its most recent all-time high. And just as we were grappling with all this volatility, just to add to this mix, we now have an US presidential election which has thrown up an historic verdict. Donald Trump has won a historic victory, becoming only the second president in US history to win 2 non-consecutive terms. So what does all this mean for equity markets and what potentially lies ahead, especially for equity markets here in India? Well, that's exactly what we are going to discuss in this video. Ladies and gentlemen, we saw in part 1 of this series how the nearly 8% correction that we have witnessed in the Nifty so far since its most recent all-time high is essentially a part of a volatile phase in equity markets that essentially sets in once the Federal Reserve in the US starts its rate cut cycle. In fact, we saw in part 1 of this series how such drawdowns are very common in the immediate aftermath of the Fed starting its rate cut cycle, especially when the Fed kickstarts its rate cut cycle with a larger than average 50 basis point cut, which is what the Fed has done this time round in 2024. So for example, if you go back to September of 2007, which is the last time the Fed kickstarted its rate cut cycle with a 50 basis point cut, we saw that as soon as the Fed started its rate cut cycle on 18th of September 2007, we got a furious rally in the Nifty over the next 4 months, which went on till January of 2008. And in this intervening period of just 4 months between September 2007 and January 2008, we got a 38% rally in the Nifty, a 38% rally in just 4 months. But we also saw that if you take a closer look at how the Nifty behaved during this 4-month period, you would notice that this was hardly a period when the Nifty went up in a straight line. Far from it, this was a period when the Nifty experienced a very choppy ride. Because this was a period when the Nifty experienced drawdowns of more than 5%, not once, not twice, but as many as 3 times. And all of this packed within a short span of just 4 months. The first amongst these 3 drawdowns was a correction of almost 9%. The next one was a correction of almost 7%. And the third one was also a correction of almost 7%. And all this played out within a span of just 4 months. Ladies and gentlemen, just think about it. If this is the benchmark of how the Nifty typically behaves in the immediate aftermath of the Fed starting its rate cut cycle with an initial cut of 50 basis points, then suddenly the nearly 8% correction that we have witnessed with the Nifty since the start of rate cuts in September of 2024 suddenly doesn't look very extraordinary, isn't it? But that automatically brings us to the next logical question, which is that Why is it that equity markets have to necessarily become so volatile in the immediate aftermath of the Fed starting its rate cut cycle, especially when the Fed kickstarts its rate cut cycle with a larger than average 50 basis point cut? Is there any specific reason for that is backed by the fundamental laws of economics and finance? Well, that's exactly what we are going to discuss in part 2 of this series. And it's critical to understand the key drivers of the ongoing bout of volatility in equity markets at a theoretical level, because only then will we be able to also accurately estimate as to how long this ongoing bout of volatility in equity markets is likely to last. Now, when you get down to exploring what are the possible drivers of the ongoing bout of volatility in equity markets, there are a number of possible drivers that come to mind. Firstly, we have an escalating conflict in the Middle East between Iran and Israel. On top of that, some time back, we also got announcement of a very large stimulus program in China. And each of these factors undoubtedly have played their role. But none of these factors can sufficiently explain as to why the current bout of volatility that we have been witnessing in equity markets continue to persist. For example, the China stimulus news is now completely behind us. What do I mean by that? Well, when the news initially broke about the announcement of a large stimulus package in China, it indeed played a role in diverting at least some amount of FII flows from India towards China. But it became very clear very soon that the scale of the stimulus this time around was nowhere going to be anywhere close to the scale of the stimulus that was announced by the Chinese government during the time of COVID in 2020 or back in 2014. And definitely nowhere close to the scale of the stimulus that was announced by the Chinese government back in 2008. And as soon as it became very clear that the scale of the stimulus this time around was not going to be very large, even the Chinese market started to give up at least some part of the gains that were accrued in the immediate aftermath of the announcement of the stimulus in China. And with regards to the conflict in the Middle East, well, that's a conflict that does keep flaring up from time to time. But there as well, we can see a very clear trend emerging, which is that whenever there's an escalation in the conflict, there is some amount of upheaval that is witnessed in financial markets. But as soon as things start to normalize on the geopolitical front, things start to normalize with financial markets as well. And yet, despite the China stimulus news being completely behind us now, despite the conflict in the Middle East having subsided at least to a certain extent by now, there is no end in sight to an end in volatility in equity markets that we have been witnessing since the first week of October 2024. Clearly, there's got to be something that's driving this current bout of volatility in equity markets that's larger than the news related to China stimulus, that's larger than even the conflict in the Middle East. What's the real driver of the ongoing bout of volatility in equity markets? Well, if you ask me, I believe that almost every instance of a large drawdown in equity markets, especially in the last 15 years, is essentially an outcome of a liquidity squeeze setting in the financial markets. And the factor that is driving a liquidity squeeze in the US financial system right now is a very significant spike in US government bond yields in the last couple of weeks. So this chart that you see on your screen right now tracks the yield of US government 10-year bonds since the beginning of 2023. And as you can see, in the last couple of weeks, we have seen a very significant spike in US government 10-year bond yields. What's been the scale of this spike? Well, on 16th of September 2024, that's 2 days before the start of the most recent rate cut cycle by the Fed, US government 10-year bond yields were at 3.62%. By 4th of November 2024, that's 1 day before the US presidential election, 10-year US government bond yields had climbed to 4.31%. That's a spike of 69 basis points in a span of just 1.5 months. But why have bond yields gone up so significantly within such a short period of time? Well, bond yields have been going up since the start of rate cuts because of widespread fears, especially amongst bond investors, that the Fed is possibly cutting rates by too much too soon. And this is happening, they fear, at a time when the economy is still reasonably strong. And this, they fear, will lead to a situation where a lot of consumers and businesses will take the benefit of cheap interest rates and will indulge in excessive spending. And that can potentially lead to inflation once again starting to go up. And in lieu of inflation expectations starting to go up in the near future, these bond investors are driving up US government bond yields. It's also worth noting that there's arguably nothing new in bond yields starting to spike in the immediate aftermath of the Fed starting its rate cut cycle. As I'm going to explain a little later in this video itself, this is something that has happened in previous business cycles as well, especially in business cycles where the Fed has kickstarted its rate cut cycle with a larger than average 50 basis point cut as the first cut. And if you want to understand the implications of a almost 70 basis point increase in US government 10-year bond yields over the last 1.5 months, well, you need to look at this in terms of what would have been the performance of an investment in US government 10-year bonds over the last 1.5 months. And had you actually done an investment in US government 10-year bonds over the last 1.5 months, let me just say that the performance of that investment would have been very, very terrible. Now, those of you who are familiar with the concept of bond pricing would know that in case of bonds, bond yields and bond prices move in opposite direction. So if you have yields moving up by almost 70 basis points in a span of 1.5 months, that would basically mean that bond prices would come down quite significantly during this time. But by how much? If you would have invested $100 in a US government 10-year bond on 16th of September 2024, when bond yields were at 3.62%, the value of this $100 would have been reduced to $95 by 4th of November 2024. That's a loss of 5% in a span of just 1.5 months. If you analyze this loss, this would translate to a loss of 32% per annum. Mind you, we are talking about US government 10-year bonds, which are almost universally accepted as world's most risk-free asset. And in case of the world's most risk-free asset, we are talking about a loss of 5% in the span of just 1.5 months. That's almost equity-like volatility. And whenever you get a big spike in volatility in US government bond market, you get a spike in this red line. This red line represents what is called the BofA ML MOVE Index. BofA stands for Bank of America Merrill Lynch MOVE Index. Bank of America Merrill Lynch basically owns this index. This index tracks the volatility in US government bond market. Now, those of you who are seasoned investors in the equity market would be familiar with something called the VIX. VIX is the index that tracks volatility in the equity markets. The equivalent of VIX in case of US bond market, US government bond market, is MOVE Index. And this is what is represented by the red line. A reading of more than 100 in the MOVE Index usually represents a higher than average level of volatility in the US government bond market. The reading of more than 120 usually represents a very, very high level of volatility in the US government bond market. What we have had in the last 1 week or so is the MOVE Index shooting up to as high as 136, which is a very, very high reading. And this was caused by this almost 70 basis point spike in US government bond yields over the last couple of weeks. Like this, if you go back last 2 years, you will see that these are the significant spikes that we have witnessed in the MOVE Index over the last 2 years. And each of these spikes has been precipitated because of a big spike in US government bond yields during this time. So, for example, this spike that we got in August of 2024 was precipitated because of the Japanese central bank increasing interest rate in Japan in first week of August of 2024. And that led to a large increase in US government bond yields because of fears of unwinding of the yen carry trade. We got a similar spike back in April of 2024 because of, once again, this big spike in US government bond yields around that time. Prior to that, an even bigger spike in bond yields when the MOVE Index went up to 142 because of this large spike in US government bond yields. And then prior to that, we got this mother of all spikes in the MOVE Index in March of 2023 when the MOVE Index shot up to almost 200. Why did we get this big spike? We got this big spike because of this very high profile collapse of this bank called Silicon Valley Bank, the SVB in California in March of 2023. This led to very large-scale dislocation in the US government bond market around this time. In fact, the scale of the dislocation was so large that the Fed was forced to intervene. The Fed had to temporarily abandon its QT program, the quantitative tightening program, and it had to go back to money printing for a short period of time in order to provide liquidity to the US government bond market. And that's how this spike in bond volatility in the US government bond market was brought under control. Now, you might be wondering, why is it that we are talking about all these complexities related to volatility in US government bond market when the issue at hand is a correction in equity markets, and that too equity markets here in India. What do equity markets here in India have got to do with volatility in the US government bond market? Well, for that, you need to look at the chart representing the volatility in the US government bond market, basically the red line, the MOVE Index, in conjunction with the chart of the Nifty. So let's do that. So for that, we'll first push up this red line and we'll add the chart of the Nifty, which is the blue line here. And when you look at these two lines in conjunction, we can clearly see that they are almost mirror images of each other. These two lines move in tandem, but in opposite directions. When the red line, which is the MOVE Index and represents US bond market volatility, when the red line shoots up, usually the Nifty, which is the represented by the blue line, that usually witnesses a downtrend, and vice versa. Whenever US bond market volatility starts to subside, Nifty usually witnesses strong rallies. And this is what probably explains why Nifty has been under pressure over the last couple of weeks, because this has been a period where US bond market volatility has shot up very, very significantly. But have you thought about why is it that the MOVE Index and the Nifty usually move in tandem but in opposite direction? If you want to really understand why is it that the MOVE Index and the Nifty move in tandem but in opposite directions, then you need to go back to this chart, which represents how the US government 10-year bond yield has moved since January of 2023. And as we saw, there's been a big spike in US government 10-year bond yields over the last couple of weeks. On 16th of September 2024, US government 10-year bond yield was at 3.62%. By 4th of November 2024, we saw this had gone up to as high as 4.31%. If you translate this and look at this in terms of how an investment of $100 in US government 10-year bonds would have performed during this time, this would translate to a $100 investment in US government bond done on 16th of September 2024 being reduced to $95 by 4th November 2024. That's a loss of 5% in a matter of just 1.5 months. Now, when it comes to US government bonds, what you also need to understand is that they are not just an investment option. They are also almost universally accepted as the world's most risk-free asset. And by way of being the world's most risk-free asset, they are also considered to be the most pristine form of collateral if you wish to pledge them and if you want to borrow against them. And this is something that institutional investors, especially foreign institutional investors, the FIIs, routinely do. They invest in US government bonds on which they can potentially earn a return of 3 to 4% per annum, and then they can pledge these bonds as collateral and they can borrow against these assets at a relatively cheap rate. And with this borrowed money, they can then invest in stocks on which they can potentially generate a significantly higher return. And US government bonds are considered to be such a pristine piece of collateral that FIIs can borrow up to 98, even 99% of the value of these bonds by pledging them as collateral. Now, this is what would have happened had a FII invested $100 in US government 10-year bonds on 16th of September 2024. The FII could have invested $100 in US government 10-year bonds on this date, and then the FII could have pledged these as collateral with a lender, and against these assets, the FII could have borrowed up to $98, and then the FII would have been at liberty to use these $98 to invest in stocks which typically generate a significantly higher rate of return compared to bonds. Now, the value of these $100 worth of bonds, as we saw a little while back, fell to $95 by 4th of November 2024. Now, against the $100 worth of bonds that were initially pledged, the FII could borrow up to $98. But the value of the bonds which have been pledged with the lender has now fallen from $100 to $95. And the maximum amount that the FII is now eligible to borrow against these bonds has also now come down by 5%. It is now only $93. So you now have a situation where the FII has actually borrowed $98, but his maximum eligibility to borrow is $93. And this is going to lead to a situation where the lender is going to insist that the FII returns this excess $5. This phenomena is what is called margin call. And when you get a margin call, the FII has no other option left but to sell stocks worth $5 in order to return these $5 to the lender. In reality, it gets even worse, because during times when there's a big spike in bond volatility, lenders usually insist on a higher rate of haircut. Lenders during such times will not let you borrow $98 by pledging $100. Against a $100 collateral during times of high bond volatility, lenders will probably lend you only $95. So the amount of collateral that you have to pledge during times of high bond volatility tends to go up during such times. And as a result, the amount of stocks that FIIs typically have to sell in order to honor the margin call during times when there is a spike in bond volatility invariably tends to be very, very substantial. And that's why you tend to invariably get substantially large sell-offs in equity markets whenever there is a substantially large spike in bond volatility. The other important point that you also need to understand at this stage is that during times when there is a big spike in bond volatility, the scale of the sell-off in stocks in case of emerging markets is always going to be significantly higher than the scale of sell-off in case of developed markets. And why is that? Well, try to understand it this way. When a FII gets a margin call, and he has holdings in his home country, which typically tends to be US, and he also has equity investments in emerging markets like India. Between these two sets of holdings, his holdings in India are always going to be far riskier compared to his equity holdings in his home country, which is US, because in case of his equity investments in emerging markets like India, apart from the equity market risk, there is this additional foreign exchange risk. And that's why when this FII is going to get a margin call, the logical thing to do for this FII would be to first liquidate his riskier investments, which are his investments in emerging markets like India. And that's why whenever you get into situations where there's a big spike in bond volatility, the scale of sell-off in equity markets in emerging markets such as India always tends to be higher than the scale of sell-off in markets like US. Now coming to the most important question. Now that we have got this big spike in US government bond yields and that has caused the Nifty to correct by almost 8%, what is it that we can expect from the Nifty going forward? Now, I don't have a crystal ball and I have no means of predicting what lies in store in the future. But we do have an instance of something very similar happening in a previous business cycle, and to that extent that serves as a very, very useful reference point for us to go back and have a look at this stage. And for that, we need to go back to September of 2007, which was the last time when the Fed kickstarted its rate cut cycle with an initial cut of 50 basis points, the same quantum of cut with which the Fed kickstarted its rate cut cycle in 2024. And what happened to 10-year bond yields after the Fed started to cut Fed funds rate in September of 2007? Well, we can see something very similar happened back then as well. We got not one but two instances of very significant spike in US government 10-year bond yields. The first one was a spike of almost 40 basis points. The second one was a spike of almost 50 basis points. That's not very different from the 70 basis point spike in US government bond yields that we have got in this business cycle since the Fed started to cut Fed funds rate in September of 2024. Now, as you can see here, in these two instances, we indeed got quite significant spike in bond yields. But in both these instances, bond yields could not sustain at higher levels for too long. And why is that? And that's because while bond investors can drive up bond yields temporarily because of fears related to inflation starting to go up in the near future, bond yields can sustain at higher levels only if subsequent data related to inflation can confirm that inflation is indeed starting to go up. However, if subsequent data related to inflation indicates that inflation in fact is starting to trend downwards, then there is no case for bond yields to sustain at higher levels. Bond yields will absolutely start to collapse, and this is exactly what seems to have happened after September 2007 as well. Despite these two instances of spike in bond yields, the larger direction of bond yields was absolutely towards the downside, and that was because the economy was weakening at a very, very fast pace and inflation was trending downwards at a very, very fast pace. Of course, from January 2008 onwards, we got the onset of a recession in the economy, and the effects of that recession started to become very, very clear as we headed towards the end of 2008, especially after September 2008, which is when we got the bankruptcy of Lehman Brothers. Situation started to deteriorate very, very badly. And as you can see, from October 2008 onwards, we got a complete collapse in US government 10-year bond yields. And what is the effect of falling bond yields on equity markets? Well, for that, we need to look at the charts of 10-year bond yields and Nifty in conjunction. And when you see that, we can clearly see, and this is something that we have already covered in part 1 of this series, that between September 2007, when the Fed started to cut Fed funds rate, and January 2008, which is when we got the onset of the recession, we got these two big spikes in bond yields. And because of these two big spikes in bond yield, we got a ride in Nifty that was extremely choppy. During this 4-month period, we got not one, not two, but 3 instances of the Nifty correcting by more than 5%. The first one was a correction of almost 9%. The next one was a correction of almost 7%. And the third one was also a correction of 7%. All of this was packed within a span of just 4 months. But overall, directionally, bond yields continued to fall during this time, and as a result, directionally, the Nifty still managed to rally 38% during this 4-month period, despite 3 instances of Nifty correcting by more than 5% during this time span. Of course, falling bond yields are stimulative for stocks only as long as the economy is still growing. Once the economy slips into a recession, falling bond yields are no longer stimulative for stocks, and that's why from January 2008 onwards, which is when the US economy slipped into a recession, we got a brutal 60% correction in the Nifty between January and October of 2008. Now, those of you who have followed me on my YouTube channel for a while now would know that my base case for a very, very long time has been that we'll see a replay of something very similar in this business cycle as well. It's been my long held view that once the Fed starts to cut Fed funds rate in this business cycle, we'll see bond yields starting to trend downwards, and that in turn will help trigger a rally in the Nifty. Of course, there will be bouts of volatility in bond yields as well as in Nifty as we had back in 2007. But overall, the direction of bond yields, I believe, is likely to be towards the downside, and the overall direction of the Nifty post rate cuts is likely to be towards the upside. Of course, this rally, I believe, is likely to continue all the way till the onset of a recession in the US. Once we get an onset of a recession in the US, I believe that's the point where the equity market rally will start to fizzle out and will eventually pave the way for a sizable correction in equity markets to play out. The reason I say that we are very likely to see a replay in this business cycle of what was witnessed back in 2007 is because I have pretty high conviction at this stage that there is very little chance of inflation being able to stage a comeback, and hence I believe that the high bond yields that we have seen in recent weeks is very unlikely to sustain for a very long time, and that these high bond yields will eventually start to come down quite substantially, and as bond yields start to come down very substantially, bond market volatility will also start to come down very substantially, and as and when that happens, that will pave the way for a resumption of the equity market rally that we were witnessing till the end of September. The reason I say there is very little chance of inflation being able to stage a comeback is because of 2 reasons. First is low oil prices. Second, the very weak state of the US labor market. Let's first look at oil prices. Well, this chart shows us how oil prices have trended over the last one year. I'm talking about Brent crude. Brent crude prices have crashed literally from almost $97 per barrel last year to under $70 per barrel as recently as September of 2024. That's a correction of a whopping 28% in the last 1 year. Of course, we have seen some retracement since then up to about $81 per barrel because of the conflict in the Middle East. But we have also seen that as the conflict in the Middle East has started to subside to a certain extent, oil prices have also started to subside, and they have now settled down closer towards the lower end of the range that we have witnessed over the last 1 year. In fact, if you look at Citibank's forecast, they believe that oil prices are likely headed towards $60 per barrel by 2025. What does this tell us about oil demand? Low oil prices are symptomatic of low oil demand, and low oil demand basically means lesser amount of goods and merchandise is being transported across the world. Lesser amount of goods being transported across the world basically indicates that there is a lower level of economic activity happening around the world. This is one of the most potent signs that the global economy is slowing down. This is one of the key reasons why I believe it's very unlikely that inflation would be able to make a comeback at this stage. Let's look at the next reason. The next reason I believe that inflation will not be able to make a comeback at this stage is because of the really poor state of the US jobs market. Last week, we had the BLS, Bureau of Labor Statistics, release the jobs report for the month of October, and it painted a really bad picture, especially with regards to the rate of new job creation in the US economy for the year 2024. Earlier, the BLS's estimate was that the US economy has generated as many as 2 million new jobs in the first 9 months of 2024. That's between January and September of 2024. But in the jobs report of October, what was really glaring was that there was very significant downward revision in BLS's earlier estimate of the rate of new job creation in the US economy for the first 9 months of 2024. As per the latest estimate, BLS now estimates that the US economy was able to generate only 1.6 million new jobs. That's a downward revision of almost 20%. Such a poor state of new job creation is very, very consistent with an economy that is slowing down very, very rapidly. In fact, one can argue that this is possibly symptomatic of an economy that is headed into a recession. And ladies and gentlemen, an economy that scores so low on the rate of new job creation simply doesn't have the necessary spending power required to stoke inflation in the economy. And that's why I believe that given the state of the labor market at this stage, there is very little chance that inflation can stage a comeback at this stage. And this brings us to a very important question, which is that what should be our approach towards equity markets at this stage? If the base case view is that there is very little chance of inflation being able to stage a comeback at this stage, if the base case view is that the high bond yields that we have witnessed over the last couple of weeks will very likely start to come down sooner rather than later, then should we use the current bout of volatility in equity markets to make fresh investments into stocks? And my unequivocal answer to that is no, not yet. And the reason for that is that both these two variables that we studied earlier in this video, US government bond yields as well as US bond market volatility, both these two variables continue to remain very, very elevated. As we earlier saw, on the day before the election day in US government 10-year bond yields had shot up to as high as 4.31% and the MOVE Index had shot up to as high as 136. And as long as these two variables continue to remain this elevated, the risk of a further correction in equity markets will continue to persist. And that's the reason at this stage, we have also reduced equity allocation in the portfolio of our clients. Furthermore, we believe that at this stage, our investment decisions should be strictly guided by, should be strictly linked to what is going to happen to US government bond yields as well as bond market volatility. We must wait for US government bond yields and bond market volatility to come down before we invest any fresh money in equity markets from here on. Now, the good thing is that both US government bond yields and bond market volatility levels have started to come down. On 7th of November 2024, the Fed cut Fed funds rate by another 25 basis points, and since then, bond yields have started to trend downwards. More importantly, bond market volatility, the MOVE Index, has started to trend downwards quite aggressively. The MOVE Index has dropped from an high of 136 to 104. It is still above the danger level of 100, but it is far less uncomfortably higher than 100 than it was until last week when it was at 136. But I have to reiterate at this stage that we have to be very, very cautious at this stage. Just because these two variables have started to drop, we should not get overexcited. We have to wait for these two variables to drop. More importantly, we have to be convinced that the drop is going to be sustainable. Only after that can we afford to start taking fresh positions in equity markets aggressively. In a nutshell, ladies and gentlemen, we have to be very, very data dependent. At this stage, our investment decisions have to be absolutely guided by a rules-based approach. We simply cannot afford to have our investment decisions be guided by our gut feel. It has to be guided based on a rules-based approach, and that is exactly what we try to bring to table at medacaps.ai. Now coming to the elephant in the room that we have not been able to discuss so far in this video, which is the historic victory of Donald J. Trump in the recently concluded presidential elections in the US. What is likely to be the impact of Donald Trump's proposed policies on equity markets, bond markets, and on inflation expectations going forward? Needless to say that some of the flagship policies that he has advocated very strongly in the run-up to elections, especially those related to tariffs and tax cuts, are going to have a pivotal impact on bond yields and bond market volatility, and that in turn is going to have a humongous impact on equity markets going forward. But let's also be cognizant of the fact that Donald Trump is going to assume office only in January of 2025. And to that extent, any policy measure that he is going to advocate or push through is likely to have effects on equity markets and bond markets only over the medium to long term. This is not something that is going to impact equity markets and bond markets tomorrow. And that's why, ladies and gentlemen, I'm going to cover the potential impact of Donald Trump's victory on equity markets and bond markets going forward in part 3 of this series, more so because part 2 has already become very, very long. Ladies and gentlemen, this brings me to the end of this video. My intent in this series was not really to indulge in any kind of predictions with respect to how equity markets are likely to shape out during the course of this ongoing volatility in equity markets. Instead, my intent was to give you the necessary tools, make you aware about the key market variables which can potentially help you optimally navigate this ongoing bout of volatility in equity markets. And to that extent, I hope that you will find the discussion that we have had in this series about the MOVE Index to be very, very useful with respect to navigating the equity markets at this stage. Ladies and gentlemen, I sincerely hope that you found the insights that I shared during the course of this video to be useful. If you did, then please do like and share this video, and please do consider subscribing to my channel. This is something that is not going to cost you anything, but is going to be immensely helpful in increasing the reach of my content. Thank you very much.